Why the US wants to let homebuyers use crypto for a home loan? Crypto meets mortgages, the US housing code breaker? Welcome to Mindful Money and Meals. Today we're diving into one of the most dramatic crossroads of finance, real estate, and crypto. How the US housing market, long considered among the most rigid, conservative corners of wealth building, is now rattling its foundations thanks to digital assets. Imagine walking into a bank and instead of showing 401ks and deposits, you pull out a cryptocurrency wallet. You say, "Here's my Bitcoin, Ethereum. Can you lend me a home?" Sound futuristic? Not anymore. The regulator that oversees the US mortgage giants has just moved to let crypto holdings count for home loan qualification. That's a game changer. In this video, we'll explore what's happening, why it matters, the risks, the players, and the chilling question: are we about to see the next housing finance bubble built on digital sand? Grab a coffee, or better yet, something mindful while you listen, and let's unravel this. Section 1. The current landscape of US mortgages. To understand the impact of crypto getting into the mortgage game, we need to appreciate how traditional home loans work in the US established institutions like Fannie Mae and Freddie Mac, which guarantee or buy up the bulk of US single-family home mortgages, set underwriting and asset criteria. Historically, borrowers show income, assets, credit score, reserves, etc. Until very recently, if you held crypto, banks essentially treated it as speculative. Either you convert it to cash and wait, or it might be ignored entirely. High interest rates, rising house prices, tighter underwriting, homeownership has become harder for many Americans. Introducing crypto into the mix is a radical shift. Why now? Among several reasons: stagnant housing supply, high demand, regulatory pressure to expand access, and the soaring visibility and value of digital assets. One recent analysis noted about 1% of US homebuyers used proceeds from crypto sales toward down payments in the 2023 to 2024 period. So some crypto money was already seeping in, but the new move is deeper, treating crypto as an asset in mortgage risk assessment. Section 2. The game changer. Regulatory shift. On 25th June 2025, the Federal Housing Finance Agency, FHFA, directed Fannie Mae and Freddie Mac to begin preparing ways in which cryptocurrency holdings can be counted when assessing a borrower's mortgage application. Key points of the directive. Crypto assets must be evidenced and stored on a US-regulated centralized exchange subject to applicable law. It does not yet specify exactly which cryptocurrencies or the discounting mechanics. The idea: allow borrowers to keep crypto, not necessarily convert it first to fiat, and still count it as reserves or assets. What this means: a person holding, say, Bitcoin or Ethereum, and holding it on an approved exchange might use that holding to strengthen their mortgage application. This is huge. Why? Because housing finance has been built on concrete assets. Crypto is neither. It's volatile, it's lightly regulated, and yet it's moving in. We'll now walk through how this works and where the landmines are. Section 3. How crypto-backed or crypto-infused mortgages work. There are several models emerging. 1. Using crypto as collateral. In a crypto-backed mortgage, your crypto acts like the collateral instead of or alongside the home. If you default, the crypto may be liquidated. 2. Using crypto as part of your asset reserve profile. Rather than full collateral, your crypto holdings count in your net worth, or assets available to cure shortfall bucket. Thanks to the FHFA directive, that bucket may include crypto. 3. Using crypto as down payment via conversion. You sell crypto, move it into fiat, use it for down payment. That's already happening. Let's illustrate the collateral model. You have $1 million worth of crypto on exchange. A lender allows you to pledge that crypto as security alongside the mortgage. If the crypto crashes 50%, the lender might ask for more collateral or liquidate. Your monthly payments are still like a normal mortgage, but the risk profile is different. Interest rates? Crypto-backed loans currently carry higher rates because lenders view them as riskier. Some estimates suggest 9 to 10% higher than comparable traditional mortgages. Speed? Some libraries suggest crypto-based processes could close faster, fewer verifications, but with more risk. So yes, it can open doors to home ownership for crypto holders. But it also reintroduces volatility, regulatory uncertainty, and severe lender risk into what has long been a safe corner of finance. And the question looms, is this pushing the housing market into new, uncharted territory? Section 4. Why it's happening now. Let's explore the drivers behind this shift. A. Housing market pressures. The U.S. housing market has been under strain. High prices, low inventory, high mortgage rates. Some economists believe unlocking new asset classes may stimulate demand. B. Crypto mainstreaming. Cryptocurrency markets have matured somewhat, more regulation, more institutional exposure, and larger holdings among H&W individuals. C. Regulatory political push. The FHFA director, in his announcement, referenced the broader vision of making the U.S. the crypto capital of the world. D. Alternative asset utilization. For crypto holders, converting assets to cash triggers tax events, capital gains, loss of upside. Using crypto in situ appeals. E. Financial innovation race. Banks, fintechs, and mortgage lenders are exploring new product lines, and crypto mortgages may open fresh revenue streams and fresh risks. So we have the perfect storm, a demand-side problem, buyers priced out, an asset holder group, crypto investors, seeking leverage, a regulatory window opening, and lenders hungry for new business. But cracks may already be forming. Section 5. Risks, caveats, and warnings. This shift is not without major risk. Let's list them. 1. Volatility of crypto. Crypto prices swing wildly. If your crypto collateral falls 40% overnight, what then? Lenders may invoke margin calls, liquidation. Buyers could lose both home and crypto. 2. Liquidity and documentation issues. Regulators require these assets to be on U.S. regulated exchanges. But what about wallets, off-exchange holdings? Verification is harder than bank statements. 3. Regulatory and oversight risks. Although FHFA has issued the directive, full guidelines are still under development. Additionally, a group of U.S. senators, led by Elizabeth Warren, Bernie Sanders, and others, are probing the plan over concerns of systemic risk. 4. Higher cost of borrowing. Because crypto-backed loans charge higher interest, equity builds more slowly. Borrowers may find themselves paying more or gaining less value. 5. Housing market bubble risk. If many loans are underwritten on speculative collateral, crypto, and prices collapse, either crypto or housing, defaults may spike. Some compare echoes of the 2008 crisis. 6. Borrower behavior and education. Many crypto holders may overestimate the stability of their asset, underestimate risks of using it as loan collateral. Lenders may suffer. This is not just about a few tech-savvy buyers using crypto to buy homes. This is about integrating an entirely new asset class into a system built on stability, documentation, regulation. If that foundation shakes, consequences could be severe, not only for individuals, but for the broader housing market and financial system, which begs the question, who wins and who loses? Section 6. Who stands to benefit and who's exposed winners? Crypto asset owners who believe in long-term upside and want to avoid selling to buy property. They can keep their crypto while gaining real estate exposure. Lenders and fintechs with appetite for innovative mortgage products and willing to charge premium rates for risk. Homebuyers priced out of traditional markets but with crypto wealth. Losers, exposed. Borrowers who over-leverage crypto and then experience a price crash. Risk, home, and crypto gone. Lenders who misprice risk, especially if many borrowers default synchronously. Taxpayers and regulators, if the housing market destabilizes. Investors in housing or structured mortgage securities, if collateral quality standards drop. Warning. Often in finance, the line between opportunity and exposure is thin. Using crypto for a home loan isn't just buying a house. It's buying a house and taking on crypto risk. Two volatile assets in one deal. So how are the major players reacting? Section 7. Industry and regulatory response. Regulator. As we mentioned, FHFA issued the directive. But the full rule set, implementation criteria, risk discounts remain under development. Industry. A mainstream real estate player, Christie's International Real Estate, launched a division dedicated to crypto transactions. signaling belief in this trend. Critics. The Senate probe led by Senators Warren, Sanders, and others is warning of housing system risk. The lightly regulated and highly volatile investment asset must not become collateral for home ownership recklessly. This tug of war suggests the idea is moving quickly, but perhaps ahead of infrastructure, risk frameworks, and consumer protection. Global perspective. While many mortgage markets around the world examine crypto, the U.S. shift is especially impactful because of the scale of its housing finance system and the dominance of Fannie/Freddie. Section 8, Case Study/Real-World Examples. Let's highlight a couple of illustrative examples. Example 1. A prospective buyer holds 50 BTC on a regulated U.S. exchange. They want to apply for a $2 million home loan. Using the new criteria, their lender counts the fiat equivalent value of the crypto as part of their asset reserves. They pledge the crypto as collateral. Interest rate, 9% higher than standard. Crypto price drops 30%. Margin call triggered. They must add more collateral or risk liquidation. Example 2. A luxury property transaction handled by Christie's International Real Estate, entirely paid in crypto. High net worth buyer uses digital currency to purchase, no mortgage required, but the transaction signals the mainstream is taking crypto real estate seriously. These are early days. The broad retail market still hasn't seen mass adoption. According to one estimate, only approximately 1% of homebuyers in 2023 to 24 used crypto proceeds for down payments, but the infrastructure is being laid. We're entering what I call the crypto to housing experiment. Section 9. Implications and future scenarios. Let's look ahead and map possible futures. Scenario A. Controlled rollout. The industry implements strict rules. Crypto holdings only from regulated exchanges, collateral discounts, robust documentation, higher rates. Few defaults. The program grows moderately. Crypto becomes another asset class in mortgages. Scenario B. Lightweight regulation/rapid adoption. Many lenders chase business. Underwriting loosens. Crypto collateral cracks when prices fall. Defaults rise. Housing finance stress emerges. Regulatory fallout. Possibly a mini crisis. Scenario C. Reversal, Yaring's crackdown. After warnings or problems, regulators pull back, restrict crypto from mortgages. Market retreats, some borrowers caught flat-footed. Which scenario is most likely? My view, we're currently in scenario A, shifting toward B. The momentum is strong, regulation incomplete, asset classes volatile. Broader implications. Housing affordability. New pool of buyers may bid up prices further in some markets. Credit markets. Securitization of crypto mortgages may begin. Will investors understand the risk? Wealth inequality. Crypto holders, often earlier adopters, younger, may gain an edge in property acquisition. Regulatory arbitrage. Which states' lenders will lead? Could we see crypto mortgage hubs? Tax and legal. Crypto holdings involve tax reporting, chain of custody issues. Using them for mortgage adds complexity. For you, the viewer, if you hold crypto and dream of home ownership, this might look like a shortcut. But shortcuts never come without trade-offs. Know the terrain. Section 10. Practical takeaways for prospective borrowers. If you're thinking of using crypto to get a home loan, here are the questions you should ask. 1. Is my crypto held on a U.S. regulated exchange with required documentation? If it's in self-custody or offshore, likely it won't qualify. 2. What discount, haircut, does the lender apply to my crypto value? Because volatility means they'll treat it more conservatively than cash. 3. What happens if the crypto value falls? Will I receive a margin call? Can I add fiat collateral? 4. What interest rate am I paying compared to a normal mortgage? Because higher risk equals higher cost. 5. Are there additional fees or special conditions, e.g., cannot sell the crypto until mortgage is paid off? 6. Do I understand the tax implications? Using crypto as collateral may still trigger events if you later liquidate. 7. What happens if the lender goes bankrupt or the exchange holding my crypto is compromised? What protections exist? 8. Am I leveraging two volatile assets, housing and crypto, at the same time? If one fails, impact magnified. My advice: for most mainstream buyers, especially first-time buyers, sticking with traditional assets and simpler processes may be safer. Using crypto for mortgages is advanced, niche, and carries risk. But for crypto-savvy investors with strong risk tolerance, it may represent an opportunity, provided you proceed with eyes wide open. Section 11. Bigger picture. What does this mean for the housing market and the economy? What are the ramifications for the U.S. economy and housing system? Increased asset correlation. If crypto and housing markets become linked, collateral plus mortgages, a crash in crypto could ripple into housing. Systemic risk. The 2008 crisis taught us that innovation in lending without transparency can topple markets. Integrating crypto may expose new vulnerabilities. Democratization versus exclusion. On one hand, crypto holders gain access to home ownership. On the other, those without crypto may be further marginalized. Regulatory precedent. Does this signal that digital assets will be treated like other wealth for credit decisions? That could have far-reaching impact on consumer finance, loans, insurance. Behavioral shifts. If buyers believe holding crypto gives them home loan power, we may see speculative behavior, buying property as a lever for crypto wealth, or using crypto to chase housing rather than housing for living. In essence, we're witnessing the beginning of a new financial ecosystem, where digital and traditional assets merge. The promise is exciting, the peril is real. Housing isn't just about homes, it's about community stability, wealth accumulation, social equity. If we destabilize its roots, the fallout could be broader than individual borrowings. Section 12. Conclusion. Let's wrap this up. Today, we explored how the U.S. housing finance framework is evolving to include cryptocurrency, something many of us would have thought hypothetical even a few years ago. We looked at the mechanics, the drivers, the risks, the scenarios, and the practical considerations. The key takeaway: while the door is opening for crypto assets to enable home loans, this is not a free pass. Leveraging crypto for mortgages means accepting volatility, regulatory uncertainty, higher cost, and systemic exposure. If you're a crypto holder considering a home loan, do not leap blindly. Understand the terms. Examine the worst-case scenario, crypto crash plus mortgage default. Evaluate whether you're comfortable with that risk. If you're a prospective homebuyer without crypto, be aware this shift may increase competition and possibly housing costs in some markets. And for society, this is a moment of potential disruption. If done carefully, it could expand access and create new financial pathways. If done recklessly, it could sow the seeds of another housing crisis, this time layered with digital asset complexity. At Mindful Money and Meals, we believe in awareness, caution, and strategic thinking. Don't let the glimmer of crypto lets me buy a house blind you to the many moving pieces behind it. If you found this video useful, please hit like, subscribe, and click the notification bell so you don't miss our next deep dive, where we'll examine crypto mortgages worldwide, lessons from Europe and Asia. Until next time, stay alert, stay mindful, and invest not just with your wallet, but with your mind. This is Felix. See you next time.